Ever found yourself looking at, say, your payslip or maybe skimming a news headline about the UK budget and just felt a wave of jargon wash over you?
Hmm.
It's like trying to decode a secret language, isn't it? Trying to figure out what income tax or national insurance truly mean for, your wallet.
It's a really common feeling, yeah.
Yeah,
The world of finance, and especially tax, can seem, well, deliberately complex sometimes, hiding crucial stuff behind technical terms.
absolutely. Well, today we're taking a direct deep dive into the fundamentals. UK income tax and national insurance contributions. Our sources give a really comprehensive look at how UK income is taxed, everything from earnings to investments.
Yeah, and our mission really is to cut through all that complexity. We want to sort of distill the core concepts, maybe unearth some surprising facts,
Mm-hmm.
and help you understand not just what the rules are, but crucially, why they matter to your own financial life. So you can walk away feeling genuinely well-informed, without getting lost in the weeds.
Okay, let's start with the big picture then. UK taxation. We're focusing mainly on income tax and national insurance. Today, they're the two big ones for most people, right?
Exactly. And income tax is not just some abstract deduction. It's actually one of the main ways the government gets its revenue. It directly funds public services.
And a quick, important reminder, the UK tax year runs from April 6th to April 5th,
Yeah,
which can sometimes trip people up compared to a calendar year.
it can. And what's often missed, I think, is how dynamic tax law actually is. It's not static.
Right.
You've got foundational acts like the 1988 one, but then the Annual Finance Act brings in new measures. Things are constantly evolving, so what's true today might, well, change slightly next year.
That brings us nicely to a really fundamental question for the taxman. Who are you? And this involves two key ideas, residence and domicile.
Hmm.
Your tax obligations here often hinge on how you fit these definitions.
Absolutely. Let's unpack residence first. Basically, you're automatically a UK resident for tax purposes if you're physically present here for at least 183 days in a tax year. Simple as that.
Okay, 183 days.
But if your time here is less than that, well, it gets a bit more intricate. The statutory residence tests kick in then. They look at various factors, your ties to the UK, things like that. It can get quite complex.
And the main point is,
The main point is, if you are a UK resident, you're generally subject to UK income tax on your worldwide income, earned and unearned.
worldwide. So income you generate anywhere on the globe could be taxed here.
Potentially, yes. That's the starting position.
So what if you're earning income from different countries? How does the UK stop you being taxed twice on the same money?
Well, that's where reciprocal tax treaties come in.
Yeah.
The UK has agreements with many countries specifically designed to prevent that double taxation.
Right.
These treaties basically ensure income is usually taxed just once, either where it arises or in the UK, and often give credit for tax already paid somewhere else. So it avoids that unfair burden.
Okay, that makes sense. Now let's talk about domicile. You said it's different from residence.
Very different, yes. Think of domicile as the country an individual considers their permanent home, their sort of long-term anchor, if you like.
And how do you get that?
You usually acquire it at birth, typically from your father if your parents were married, or your mother if they weren't,
Okay.
and changing your domicile.
Mm-hmm.
That's not something that happens casually. It needs you to live in a different country with a really clear, permanent intention to stay there, and you need to actively sever your ties to your old country. It's a big legal shift, not just, moving house.
So why does domicile actually matter for your finances? What's the practical impact? What's the so what?
Okay, this is crucial, especially when it comes to inheritance tax, or IHT. Your domicile is the main thing that dictates the scope of your IHT liability.
How so?
Well, if you're UK domiciled, your worldwide assets are potentially subject to IHT, everything you own anywhere. But if you're non-domiciled, generally only your UK-based assets fall into the IHT net.
Ah, I see. That's a big difference.
It is, though there's a notable exception. If a non-domiciled person has been resident here in the UK for 15 out of the previous 20 tax years,
Okay.
they are deemed to be UK domiciled just for IHT purposes.
Yeah.
That's a really significant rule for long-term residents who aren't originally from the UK.
Wow, okay. That really underlines why knowing the difference is so important for, say, financial planning.
Absolutely.
Before we dive deeper into the actual calculations, maybe let's just quickly clarify a couple of those basic terms. When we talk about capital gains tax, CGT.
Right. CGT is the tax on the profit you make when you sell or dispose of certain assets.
Hmm.
So things like a second property or shares, perhaps, it's not taxed on your regular income.
Got it. Profit on assets. And then
Yep.
there's earned versus unearned income.
Yeah, simple distinction, but important.
Yeah.
Earned income is what you get from working employment, self-employment. So salary, profits, bonuses, even pensions count as earned income. Unearned income is, well, everything else not from employment. Interest from savings, dividends from investments, rental income, that sort of thing.
Okay, great. With those definitions clear, let's get into what the taxman actually considers assessable income. It sounds like income tax is levied on most income you receive in a tax year. It casts quite a wide net.
It really does, yeah. It covers income from employment, self-employment, pensions, rental income, interest, dividends. The list goes on.
And for UK residents, it's generally all that worldwide income that's potentially taxable.
Generally, yes, depending on the type and amount. So, your salary, wages, commission, profits from your business or profession, even things like inventor's income, tips, bank interest, dividends from companies, income from government stocks, rents, and even the value of taxable employee benefits, things like company cars or private medical insurance provided by your employer, they all fall under assessable income.
That is pretty comprehensive. But what's really interesting, and maybe an aha moment for some listeners, is what isn't assessed for income tax. Are there common things people think are taxable but actually aren't?
Oh, definitely. Yes. For instance, redundancy payments, they aren't assessed for income tax if they fall below a certain threshold.
Okay.
Also, certain shares you might get through an employer's share incentive plan or interest from NS&I savings certificates, those are often non-assessable.
Right. And what about windfalls, like the lottery?
Ah, good question. Lottery prizes and, interestingly, casual gambling profits, like from the football pools or a bet on the horses, are generally not subject to income tax.
So if you win big on the lottery, that whole lump sum is tax-free. That's a common question, isn't it?
For income tax purposes, yes, it is. Also, things like wedding presents, unless they're clearly payment for a service, are exempt.
Okay.
Certain retirement gratuities within limits, scholarships or educational grants for full-time students, and even, funnily enough, interest you might receive on a tax rebate from HMRC. That's not assessable too.
Huh. Interesting.
It just shows that not every single bit of money coming in is automatically taxed.
That is really good to know. Okay, so now we understand what counts as income. Let's talk about how you can, perhaps strategically, reduce your taxable income. Allowances and deductions seem key here.
Absolutely crucial. The personal allowance is the big one. It's that slice of your income you don't pay any tax on before the rates are applied.
And that's usually £12,570.
For most people, yes, £12,570 currently. However, and this is a really crucial insight for higher earners, this allowance starts to reduce.
How does that work?
For every £2 your income goes over £100,000, your personal allowance decreases by £1.
Oh.
Which means between £100,000 and £125,140 of income, your effective marginal tax rate isn't just the 40% higher rate, it's actually a whopping 60%.
60%, really?
Yes, because you're losing the allowance and paying the higher rate tax. It's a vital point for anyone earning in that bracket. It highlights why pre-tax deductions, like pension contributions, can be incredibly beneficial in that specific income zone.
That's a massive difference.
Wow. And are there other specific allowances too?
Yes, there are a few specialized ones. There's the marriage allowance, which lets someone transfer a bit of their personal allowance to their spouse or civil partner under certain conditions.
Okay.
Then there's the older married couples allowance, but that's only for couples where at least one partner was born before April 6, 1935. And there's also a blind person's allowance. So, targeted relief for specific circumstances.
Got it. Now, beyond the main personal allowance, how can saving and investing smartly help cut your tax bill? You mentioned unearned income earlier.
Right. So here, the personal savings allowance, the PSA, is really key. It lets you earn a certain amount of interest income tax-free each year.
How much is that?
Well, it depends on your income tax band. For basic rate, 20% taxpayers, it's typically £1,000. For higher rate, 40% taxpayers, it's £500.
And for additional rate?
For additional rate, 45% taxpayers, it's zero. So they don't get a PSA. But for most people, it means a good chunk of their savings interest is tax-free.
And what about income from shares, dividends? Similar idea. There's a dividend allowance, or DA. It allows a certain amount of your dividend income each year to be tax-free. The exact amount has changed over the years, so it's worth checking the current level. And Really importantly, any dividends you receive from investments held within an individual savings account, an ISA, they are completely tax-free.
Ah, which is why ISAs are so popular.
Exactly. It makes them a really powerful tool for tax-efficient saving and investing, especially with the long term.
You also hear sometimes about allowances for micro-entrepreneurs. What are those?
Ah, yes, those are specific allowances for property income and trading income. They basically let you earn small amounts, currently up to £1,000 per year for each type,
Mm.
from activities like, say, selling things online or renting out a room occasionally, completely tax-free.
Okay.
It's designed to encourage that sort of small-scale activity without immediately getting bogged down in tax reporting.
Right. So we have allowances taking chunks off your income. What about deductions? How do they work?
Deductions are slightly different. They're specific expenses you can subtract from your gross income before your taxes worked out.
Like what? What are the main examples?
Well, key examples include contributions you make to certain types of pensions, provided they're within the annual limits, of course.
Right. Pension contributions.
Also, certain charitable contributions, especially those made using gift aid, which we can maybe touch on later, can reduce your taxable income.
Okay.
And for the self-employed or employees with specific job-related expenses, you can deduct allowable expenses that are wholly and exclusively incurred for the purpose of your trade or employment.
Wholly and exclusively. That sounds quite strict.
It is quite strict. It means the expense must be purely for the business or the job, not for any personal benefit. So distinguishing that can sometimes be tricky.
Okay. So once you've worked out your total income, taken off any deductions, then taken off your personal allowance and any reliefs, you get your taxable income figure.
Exactly.
And then it's time for the tax rate ladder. How much do you actually pay on those different slices of income?
Right. The UK uses a progressive system. Different portions of your income are taxed at increasing rates. So currently, the basic rate is 20%.
And that applies up to what level of taxable income?
That applies on taxable income up to £37,700.
Okay, 20% up to £37,700. And after that?
Then the higher rate kicks in. That's 40%. And it applies to the slice of your income between 37,701 muddles and 125,140 pounds.
40%. And for the highest earners?
For taxable income above 125,141 pounds, the additional rate applies, which is currently 45%.
45%. Okay. And it's worth remembering, isn't it, that Scotland has its own set of rates and bans?
Yes, absolutely. Scotland has devolved powers over income tax rates and bans that apply to non-savings, non-dividend income. So the figures can be different there. Always important to check if you're a Scottish taxpayer.
Good point. Now, what if someone has different kinds of income, say a salary, some bank interest, and some dividends? Is there a specific order they get taxed in?
Yes, there's a set order of priority. HMRC looks at it this way. First, your personal allowance and any other reliefs are used against your non-savings income.
So your salary or profits first?
Exactly. Employment income, self-employment profits, pension income. That gets priority for the allowances.
Then what?
Then your savings income, like bank interest, is considered. After that, your dividend income is taxed.
Okay.
And finally, if you have them, any chargeable gains from non-qualifying life assurance policies are brought into the calculation. It's quite a structured approach. Ensures consistency.
Right. Now, for the really practical bit, how does the tax actually leave your pocket and get to HMRC? For most employees, it's fairly automated through work, isn't it?
It is, yes. For employees, HMRC collects tax right at the source through the pay-as-you-earn system, usually just called PAYE.
PAYE.
Your employer deducts the income tax directly from your wages or salary each time you're paid. They use your tax code, factor in your allowances, any benefits you get.
And send it off to HMRC.
Exactly. That's why it's so important to check things like your P45 form when you leave a job and your P60, which is your end of tax year statement from your employer, just to make sure the figures look right.
Can you give us a quick example?
Sure. Let's take Sarah. She's 24, earns £27,430. Her personal allowance is £12,570.
Okay.
So her taxable income is £14,860. £27,430 minus £12,570. That £14,860 falls entirely within the basic rate band.
So 20% of that.
Exactly. 20% of £14,860 is £2,972. That's her total income tax for the year, and her employer deducts a portion of that each month through PAYE.
Right, fairly straightforward for employees then, mostly. But for the self-employed, it's a completely different ballgame.
Oh, completely different,
Yep.
yes. Self-employed people pay their income tax via the self-assessment system. It's based on the profit they report.
So they have to calculate it themselves.
Pretty much, yes. You calculate your own tax liability, usually either online through the HMRC portal or often with the help of an accountant.
And when do they pay?
Payments are typically made in 2 installments called payments on account, usually by January 31st following the end of the tax year, and then another by July 31st.
Right. Can you give an example for self-assessment too? Maybe a higher earner?
Okay, listen to go, Michael. He's 36, self-employed. His gross profits are £240,000, and he has £40,000 in allowable business expenses.
So his net profit is £200,000.
Correct. Now, because his income is £200,000, which is well over that £125,000, £140 threshold.
His personal allowance is gone.
Exactly. His personal allowance is reduced to nil. So his entire £200,000 profit is taxable.
Wow. So how is that taxed?
It's taxed across the bands. He pays 20% on the basic rate band, £37,700, then 40% on the higher rate band from £37,701 up to £125,141.
Okay.
And then 45% on everything above £125,141. So the portion of his income from £125,241 up to £200,000 is taxed at that additional rate.
That adds up quickly.
It does. Working it through, his total income tax bill comes out at $76,203 income. It really shows how the progressive system works and how higher earners face those top rates on a significant chunk of their income.
That's a very clear illustration. What about tax on savings and investments then? How is that collected?
Well, interest from bank and building society deposits is usually paid gross these days. That means without any tax taken off beforehand.
So you have to declare it.
Yes. You typically need to declare this interest income to HMRC, either by telling them directly if your affairs are simple, or, more commonly, including it on your self-assessment tax return if you fill one out.
Okay. And you mentioned something earlier about a starting rate for savings.
Yes, the starting rate band for savings income. It's quite specific. It can allow the first £5,000 of your savings income to be taxed at 0%.
Tax-free?
Potentially, yes. But it only really applies if your non-savings income, like your salary or pension, is very low, below the sum of your personal allowance, plus that £5,000 starting rate band.
Right, so it depends heavily on your other income. Could you walk us through how savings tax might play out for people with different income levels?
Sure, let's take a few examples. Imagine Jamie. Her earned income is quite low, say £12,720, and she has £2,500 in savings interest.
Okay.
Her personal allowance, £12,570, covers almost all her earned income. This means she has a large part of that £5,000 starting rate band for savings available.
So her savings interest?
Her £2,500 savings interest falls entirely within that available 0% starting rate band. So, result, she pays zero tax on her savings.
Okay, good for Jamie. What about someone earning more?
Right, let's take Roisin. She earns £29,600 from her job and also has £2,500 in savings interest. Her total income is £32,100. Now, because her non-savings income uses up her personal allowance and takes her well above the level where the starting rate applies, she doesn't get that 0% starting rate band for savings.
Okay, so how is her £2,500 interest taxed?
Well, first she gets her personal savings allowance, PSA. Since her total income puts her in the basic rate band, her PSA is £1,000. So the first £3,000 of her interest is tax-free, 0%.
And the rest?
The remaining £1,500, £2,500 minus £1,000 is taxable. Since she's a basic rate taxpayer, it's taxed at 20%. So that's £300 tax on her savings interest.
Got it. Now, one more, maybe a higher rate taxpayer?
Okay. Let's look at Jody. She earns £49,000 and also has £2,500 in savings income. Her total income is £55,500.
So she's into the higher rate band.
Exactly. That pushes her just into the 40% tax band. Now, as a higher rate taxpayer, remember her personal savings allowance is lower. It's only £500.
Right, £500 is tax-free.
Correct. So the first £500 of her £2,500 interest is taxed at 0%. That leaves £2,000 to be taxed.
And how is that £2,000 taxed at 40%?
Not all of it. Because her income only just crosses the higher rate threshold, part of that £2,000 still falls within her remaining basic rate band, and part falls into the higher rate band.
Okay, so it's split.
Yes. In her specific case, about £770 of it would be taxed at the basic rate, 20%, and the remaining £1,230 would be taxed at the higher rate, 40%. So her total tax on savings would be around £646.
That really shows how your overall income level completely changes how savings interest is taxed, doesn't it?
Absolutely.
Yeah.
The key insight isn't just the numbers, it's understanding that interaction. It makes optimizing your savings vehicles, especially using things like ISA says, much more important as your income rises.
Definitely. And dividends, you mentioned they're taxed differently again.
Yes, dividends are paid without tax deducted, and they're taxed at different rates compared to savings interest, depending on which tax band they fall into after allocating your other income. There are specific dividend tax rates for basic, higher, and additional rate taxpayers.
Okay, so to just summarize the whole income tax calculation process then, there seems to be a clear four-stage process people can follow.
That's right. It's basically 1, work out your total income from all sources.
Okay.
2, take off any appropriate deductions, things like allowable expenses or maybe certain pension contributions.
Right. Step 2, deductions.
3, deduct your personal allowance and any other reliefs you're entitled to, like the blind person's allowance, if applicable.
Mm-hmm. Step 3, allowances.
And finally, step 4, apply the correct tax rates basic, higher, additional to the remaining income that falls into each tax band. That gives you your total income tax liability for the year.
Perfect. Okay, we've covered income tax pretty thoroughly, but there's that other big deduction from earnings, national insurance contributions, or NICs.
Yes. That is soon.
What are these exactly, and how do they differ from income tax?
Well, NICs are another form of tax, essentially, on earned income, so paid by employed and self-employed people.
But they're different from income tax.
Yes. Unlike income tax, which funds general government spending, NICs are notionally linked to your eligibility for certain state benefits. Most importantly, your state pension.
Ah, so paying NICs builds up your state pension record.
Exactly. Understanding them is pretty crucial for your long-term financial security, not just your current deductions.
And I understand there are different classes of NICs, depending on how you work.
Precisely. There are 4 main classes, though one has recently changed significantly. Class 1 is for employees. You pay primary Class 1 NICs as a percentage of your earnings between certain thresholds.
Okay.
And your employer also pays secondary Class 1 NICs on your earnings above a lower limit. So it's a cost for employers too.
Right. What about the self-employed?
Okay, so traditionally, self-employed people paid 2 types. Class 2 was a mandatory flat-rate weekly payment if your profits were above a small profits threshold.
Was.
Yes, was. It's important to note that Class 2 NICs for the self-employed were actually abolished from April 2024.
Oh, right. So self-employed people don't pay that flat rate anymore.
Generally, no. They no longer need to make those Class 2 payments to build up qualifying years for the state pension through that route. Their state pension entitlement will now mainly come from paying the other type of NICs.
Which is?
Class 4 NICs. Self-employed individuals still pay Class 4. These are contributions calculated as a percentage of their annual profits, again, between certain lower and upper profit levels.
And how are they paid?
They're paid via self-assessment, usually alongside their income tax in those half-yearly installments.
Okay. And what's Class 3?
Class 3 contributions are purely voluntary. These for people who want to top up their national insurance record to protect their state pension or certain other benefits. Perhaps if they've had a career break, lived overseas, or just don't have enough qualifying years from Class 1 or Class 4.
Right, so a way to fill gaps. Okay, that clarifies NICs. Finally, let's just touch on something that benefits society and potentially your tax bill. Charitable giving.
Ah, yes. Doing good, doing well.
It seems you can support causes you care about and possibly streamline your taxes at the same time.
You certainly can.
Yeah.
Making gifts to eligible charities is obviously great for the charity, but it can also reduce your own income tax liability. The main way this happens is through gift aid.
Gift aid, how does that actually work? It's magic.
Okay, so when you make a donation to a charity using gift aid, the charity can reclaim the basic rate tax, which is 20%, that HMRC assumes you've already paid on the amount of your gift.
So the charity gets more money.
Exactly. If you, as a basic rate taxpayer, give £80, the charity can actually claim an extra £20 from HMRC, making your donation worth £100 to them.
And what's the benefit for the donor?
Well, if you're a basic rate taxpayer, there's no direct reduction in your tax bill, but the charity benefits.
Yeah.
However, if you're a higher rate, 40%, or additional rate, 45% taxpayer,
Yes.
you can personally claim back the difference between the basic rate, 20%, and the higher rate you actually pay on the grossed up value of your donation. Usually do this through your self-assessment return.
Ah, so higher earners get personal tax relief too.
They do. And for basic rate taxpayers, making a gift aid donation effectively extends their basic rate tax band by the gross amount of the donation. so it
Yeah.
can sometimes prevent some income being pushed into the higher rate band.
Interesting. And there's also payroll giving for employees, right? How does that work?
Yes, payroll giving is another option. It allows employees to make tax-efficient donations directly from their salary before income tax is calculated and deducted.
Before tax.
Yes. So the tax relief is immediate at your highest rate of income tax. If you're a higher rate taxpayer and donate £100, it only costs you £60 from your net pay, for example. It's a very efficient way to give.
Wow, okay. What a deep dive that was into UK income tax and national insurance. We've really peeled back quite a few layers there.
We have. From those foundational ideas of residence and domicile and why they matter so much for your overall tax liability,
Hmm.
to uncovering some of those perhaps surprising types of income that actually aren't taxed at all.
And we explored the powerful impact of allowances, like the personal allowance and its tapering, and deductions in reducing your final tax bill.
Yeah, and looked at the mechanics of how different income sources get taxed. PAYE for employees, self-assessment for the self-employed, and how savings and dividends fit in. Plus, how vital national insurance is for state benefits.
It is definitely a complex landscape, isn't it? But hopefully, understanding these core principles empowers you, the listener, to navigate your own finances a bit more effectively. So, thinking about all these nuances, the different types of income, the allowances, the way tax is paid, the constant changes in the law, perhaps a final thought to leave you with. Given that constant evolution, what do you think is the biggest challenge for individuals trying to stay truly well informed about their taxes today? And maybe what single aspect of your own financial situation might you want to explore more deeply now to really optimize your understanding of your personal tax position?